debt is an asymmetrical contract. You are trading your future earnings for immediate capital. Time is commodified. By borrowing, you pull tomorrow's purchasing power into today. The mathematical cost of utilizing this time machine is called interest. It is the price tag on convenience. To measure this cost accurately, lenders use the annual percentage rate, or APR. This metric calculates the true yearly cost of capital by combining the baseline interest with any mandatory fees. In the UK financial system, there are 6 distinct credit architectures. Each maps risk and repayment in completely different ways. Misunderstanding these structural mechanics turns capital utility into a wealth extraction trap for the borrower. Navigating this matrix is the only way to ensure that a temporary need for cash doesn't turn into a permanent drain on your lifetime earnings. We begin with revolving unsecured credit. This is a highly flexible borrowing structure backed entirely by your creditworthiness, with no physical collateral at stake. A credit card functions like a tab at a bar. You make purchases throughout the month, and if you settle the balance in full within the standard 30-day grace period, the capital costs you absolutely nothing. But if you roll that balance forward, you trigger the minimum payment algorithm. Lenders design this metric to maximize their profit yield, not to help you clear the principal. This chart shows the danger of that design. If you carry a £2,000 balance at 22, following 2020 FCA regulatory changes, drawing from that reservoir incurs a flat, highly punitive rate, typically 39.9% EAR. The danger is acute for university graduates. 0% student overdrafts operate on a strict timer. When that promotional window expires, the account snaps immediately to that 39.9% rate. Revolving credit products offer immense day-to-day convenience. Mathematically, their profitability relies entirely on the borrower's behavioral failure. Personal loans offer a more rigid alternative. They utilize fixed amortization structures, meaning highly predictable monthly payments and a strict contractual end date. It functions like taking a ride in a metered taxi. The exact cost of the capital and the exact duration of the term are calculated and locked in before you depart. UK student loans, however, operate on a logic that reverses the standard rules of debt. The total balance you owe is secondary to the amount you actually earn. Conceptually, a Plan 5 student loan operates less like a traditional liability and more like a marginal graduate tax. This payroll waterfall chart illustrates the mechanics. For a graduate earning £35,000, the first £25,000 is protected. Only the £10,000 surplus is assessed, and exactly 9% drains into the Plan 5 bucket. If income drops, payment drops to zero. Any balance remaining at the 40-year mark is wiped out, without appearing on a credit file. Aggressively overpaying an income-contingent liability using traditional debt clearance strategies is a mathematical error. It destroys borrower wealth that could otherwise generate compounding returns in the market. Secured debt introduces an entirely different architecture. Here, a physical asset acts as collateral, creating a digital tether that significantly lowers lender risk and drops the APR. For mortgages, the primary metric dictating the cost of borrowing is the loan-to-value ratio, or LTV. Supplying a 10% cash deposit mathematically establishes a 90% LTV, anchoring your financial profile directly to the physical property. Borrowers must weigh the structural certainty of a fixed-rate mortgage against the market vulnerability of tracker and standard variable rates, which fluctuate with macroeconomic shifts. This stacked area chart reveals how extreme amortization schedules warp the true cost of debt. Over a 25-year timeline on a £300,000 property, the cumulative interest segment expands massively, often exceeding £150,000. Crucially, while you may only own 10% of the equity initially, you absorb 100% of the asset's price volatility risk. Secured real estate debt artificially inflates immediate purchasing power. It demands decades of flawless income generation to avoid asset repossession. While real estate generally appreciates, financing consumer assets like vehicles introduces steep mathematical danger. You are leveraging capital against rapid, guaranteed depreciation. Hire purchase, or HP, utilizes a strict linear model. Your payments consistently chip away at both principal and interest, directly leading to full vehicle ownership. Looking at these debt reduction charts side by side, the HP schedule is straightforward. Slow, steady reduction down to a zero baseline. But the personal contract purchase, or PCP, stops decreasing halfway. It offers lower monthly payments because you are not clearing the principal. Instead, a massive final balloon payment is deferred to the end. This creates the specific danger of negative equity, where the vehicle's market value crashes at a faster velocity than the loan balance decreases. Guaranteed asset protection, or gap insurance, is designed purely to shield borrowers from this vulnerability. It covers the exact delta between market value and loan balance in the event of a total loss. Ultimately, PCP is a complex rental agreement. It creates the illusion of ownership while quietly deferring massive capital requirements to the future. Overdrafts act like a glass of water on your nightstand. It is incredibly easy to accidentally dip into the red in the middle of the night, but climbing back to a positive balance takes deliberate effort. Overdrafts use an effective annual rate, or EAR. Banks frequently charge a massive 39.9% penalty for letting your account drop below zero. This regularly catches recent graduates off guard. The generous 0% interest buffers attached to student accounts disappear shortly after graduation, instantly converting a borrowed safety net into expensive debt. Navigating these systems requires understanding how the industry scores you. Credit scores are not a measure of wealth. They are predictive algorithms calculating your statistical likelihood of default. Failing to satisfy unsecured credit obligations can lead to a county court judgment, or CCJ. This is a formal court order that stays on your credit file for 6 years, signaling to all future lenders that you are a high-risk borrower and effectively locking you out of mainstream finance. To escape multi-product debt, borrowers must implement defensive strategy: a £2,000 credit card at 28%, a £5,000 loan at 9%, and a £500 overdraft at 39.9%. The Avalanche method optimizes purely for mathematical efficiency by deploying surplus capital toward the highest APR first. Conversely, the snowball method optimizes for psychological momentum. It targets the smallest total balance first, completely ignoring the rate. This dual-path flowchart demonstrates the practical application. The Avalanche path highlights the 39.9% overdraft due to its punitive rate. The snowball path highlights the same overdraft for its low balance. Advancing, both paths next target the 28% credit card. In standard consumer portfolios, these supposedly opposing frameworks often perfectly align. Regardless of the chosen framework, proactive, structured repayment is your only defense against algorithmic wealth extraction. We can now synthesize all 6 of these credit architectures into a final, practical framework. Good debt is leverage utilized to finance appreciating assets or enhance human capital at a low systemic risk. Mortgages and student loans fit squarely into this category. Bad debt is leverage used to finance depreciating assets or lifestyle consumption at high interest rates. Rolling credit card balances, punitive overdrafts, and PCP car finance sit firmly in this bad debt quadrant.